Traditional finance theory rests on one assumption, that people are rational, that they make decisions to maximize expected utility, that risk preferences are consistent, and behavior aligns with statistical logic. That model of course does not match reality. People don't weigh gains and losses in some sort of accounting method. They react differently to losing money than to gaining it, even if the amounts are the same. They fear losses more than they value equivalent wins. Their preferences shift based on how information is framed. This isn't theory, this is a root cause of repeated predictable mistakes in investing, trading, and asset allocation. It's also why the assumptions behind much of financial modeling is actually broken in practice. Prospect theory is the correction. It replaces the myth of the rational agent with a psychologically accurate model of how people actually make decisions under risk. And when you apply it to finance, the implications are profound. At the core of the prospect theory is loss aversion, the idea that losses hurt more than equivalent gains. Basically, people value avoiding losses about twice as much as acquiring gains. A $100 loss causes more emotional impact than a $100 gain provides satisfaction. This isn't just a quirk, it's consistent, measurable, and deeply embedded in human behavior. So basically, in our mind, people are risk averse when dealing with potential gains. They prefer a sure gain over a gamble with the same expected value, but people become risk seeking when facing potential losses. They prefer to gamble rather than accept a certain small loss. By the way, this emotional impact is sharpest around the reference point, usually the status quo or the mental baseline. Gains and losses are judged relative to this point, but not in absolute wealth terms. This is really hard and really abstract to explain unless without an example. So here's choice A. You have a guaranteed gain of $900, or choice B, a 90% chance to win $1,000 and a 10% chance to win nothing. Most people would pick A, even if the expected value of both choices is the same. That's risk aversion on the gain side. Now let's flip it, choice C and choice D. A guaranteed loss of $900, or choice D, a 90% chance to lose $1,000, but a 10% chance to lose nothing. Most people pick D. They'll take the gamble to avoid a sure loss. That's risk-seeking behavior. This framing inconsistency violates expected utility theory. It also explains why people often make irrational decisions under uncertainty, not because they're stupid, but because the internal value function is non-linear and reference dependent. In markets, this shows up everywhere, from how investors react to portfolio drawdowns, to how traders manage losing positions, to how clients perceive risk based on framing rather than possibility. Prospect theory also identifies probability distortion. People overweigh small probabilities but underweigh big ones. This means they overpay for lottery tickets because they think the 0.1% chance of scoring $1 million is worth it. They overinsure against rare events. A 1% chance that your car might be totaled without insurance is often too painful. This distortion derives everything from option mispricing to misaligned insurance markets. Again, it's predictable, systematic, and exploitable. In short, prospect theory replaces the rational agent with a psychologically realistic one. They're not risk averse but loss averse, reference dependent, and inconsistent when weighing down the probabilities. The model maps more accurately to the real world and to real financial behavior. So now let's map this to practical finance. Let's say in investor behavior. Loss aversion explains why investors sell winners too early and hold losers too long. It's the disposition effect. For example, selling a winner locks in a gain, it feels good, but selling a loser locks in a loss, it feels painful. So you can call this as a sunk cost as well. People delay the pain and rush to take the profits, even when it's irrational from a performance standpoint. It also explains why during downturns or financial crisis, there is a lot of panic selling. Once investors fall below their mental reference point, say break even or actually losses, the loss aversion triggers emotional overreaction. They liquidate to stop the bleeding, but not because of fundamental reasons or because their model said so. Let's now go over the pricing of risk and how we change fundamental values or intrinsic values based on the risk around a certain security. Markets are supposed to price risk in naturally into the price point, but they usually don't because loss aversion distorts the risk. Investors demand excess competition. This is because we basically over discount our intrinsic valuation of securities when there is downside volatility or risk, even if it's short-lived or medium term. And then when we have positive risks, like for example tech stocks, we undervalue them because we are loss averse, but we do not really chase wins. That's a very famous Warren Buffett quote. I'm unsure of who did it, but I think it was Buffett or Munger who said that Regardless of volatility, if you know the outcome is going to be the same, then medium term or even short term volatility doesn't even matter. For instance, if you know that a stock will go from 100 to 1,000, it doesn't matter if the stock in the short term goes back down to 50 if it will reach its original price point in 10 years. I don't think they intended for it, but it's a lesson in prospect theory and fighting against loss aversion. And even then, prospect theory shapes how performance is communicated, especially in stocks. Clients don't evaluate returns linearly, they focus on drawdowns, volatility, and relative comparisons to benchmarks or peers. A manager who loses less in a down market may earn more trust than someone who beats the market in an up year. Periods of underperformance carry more emotional weight than equivalent outperformance. Everything is benchmarked against the reference point. Basically, how much money do you put in or where do you start before the investment? Smart firms do know this. They shape their client journey to minimize perceived losses, smooth volatility, and reinforce positive framing. Basically, they're using prospect theory to soften the blow during losses and oversell the importance of certain gains. The last example we're going to talk about is behavioral portfolio construction. Traditional portfolio theory assumes investors have one utility curve and a single objective function, which is maximize the expected return for the risk diet. But actual investors often behave as if they are mental accounts. They treat different parts of their portfolio differently. For example, it's very common to have an investor that has one account for long-term growth, one account for safety, and another account for fun bets or speculative trades. This behavior violates standard theory but aligns with prospect theory. People want both upside potential and downside protection. They sacrifice efficiency for peace of mind. The implication, advisors and allocators should design portfolios that accommodate these preferences structurally rather than fight them and try and model based on one specific preference that people have. People have different risk diets depending on what strategy they're trying to employ, especially experienced investors. If you're going to take one thing away from this video, it's this: people hate losing more than they like winning. This is fundamentally the reason why during times of high volatility, intrinsic value gets slightly muddled, because people are afraid of loss aversion.